Hey, what's up, guys? John here. The new 2024 tax code is out.
The IRS is setting new tax brackets for 2024.
The agency changing the income tax brackets for the 2024 tax year to account for inflation.
So something amazing is happening, and for once I have good news. While we are all focused on the Middle East, something game-changing is happening in the Indo-Pacific. Australia and China are now coming together and writing a new chapter. And this is an economic victory for both countries and a strategic defeat for the United States.
So Japan just flipped on its interest rate policy, and this could have a huge effect on the US economy.
The Bank of Japan is expected to unwind its negative interest rate policy in 2024, and the fallout in US Treasuries could be huge.
Alright guys, so it's not looking good. Things are heating up in the Middle East again. At this time, the US is sending more troops and submarines. We essentially have a standing army in the Gulf ready to take action. There are troops on land, aircraft carriers with fighter jets, and now a nuclear submarine. And if you ever wondered if there's a military buildup, this is it. In our lead story today, US nuclear sub offers a show of force in the Middle East. Apparently, the submarine is moving through the Suez Canal towards CENTCOM's area of responsibility. And here's the interesting question. Is it now in the Mediterranean or the Arabian Sea? Are they looking to beef up Israel or patrol the Strait of Hormuz, which is the major shipping lane? And here's the thing about nuclear subs. It is meant to be hidden away, constantly patrolling and moving around the world. You're supposed to keep everyone guessing about its location. So this is most definitely a show of force to warn enemies of Israel and the United States. But that isn't all. The US has also deployed 1,000 American soldiers to the region. Missile defense systems are also heading to Saudi Arabia, Kuwait, Jordan, Iraq, Qatar, and the UAE. And that covers more or less all the countries with US military presence. And this is a military build-up because things are getting very unstable in the region. Multiple threats are coming from Iran and Hezbollah, with the Houthis firing missiles at Israel. Essentially, the entire Arab world isn't very happy with the state of affairs. They've called for immediate ceasefire, but Blinken keeps saying no. The UN Security Council resolutions aren't being passed either, so there's no stopping the chaos. 8 countries now have put their ambassadors from Israel, which has to be viewed as a strong rebuke. Amongst those countries, even Jordan and Turkey have put their ambassadors away. Now, Jordan is a designated ally of the United States, while Turkey is part of NATO. And this kind of shows that the Arab world is starting to draw a line in the sand, and the US is losing support in the region. And I have even more breaking news. This just came out a few hours ago. And if you think America is done hitting Iranian targets, you'd be wrong. According to the Pentagon, the United States just carried out new airstrikes on the Iranian facility in Syria again. They have hit Syria again on Biden's orders. Lloyd Austin says this is a precision self-defense strike in response to a series of attacks against US troops in Iraq and Syria. And we have said before that the US will defend their bases if attacked. Every time an Iranian proxy hits the US, this will force a retaliation, and that in itself will cause even more counter-strikes. So you can see this deadly feedback loop, tit for tat, which threatens to ramp up escalations. And this is a real flashpoint that could trigger everything from oil embargoes to new fronts being opened. And let's talk about this problem. Until a ceasefire happens, we can expect more and more attacks from the Iranian proxies. America has to retaliate or they'll look weak and lose even more influence in the Middle East. So both sides are essentially trapped in this box, right? Where you gotta hit back or the other side wins. The big problem is escalation where someone just miscalibrates. Now, all the talk about embargoes, oil supply cuts, and blockades all stems from this. It is not an economic strike that we have to be worried about. It's a military disaster that could prompt an economic response. So these two things are not mutually exclusive. So while the US struck Syria again, we are now seeing more escalations from another Iranian proxy. The Houthis have shot down a US surveillance drone over the Red Sea. That's the region immediately south of the Suez Canal. And the attack follows an episode last month where US destroyers shot down several ballistic missiles and drones launched towards Israel. The US objectives are the polar opposite of the Houthis or Hezbollah, so this deadly cycle isn't gonna stop. America is pushing for a humanitarian pause, but the Middle East wants a ceasefire. And you can't square this circle, right? It's literally impossible until one side concedes. And I don't see the US budging from their position. In a story from Bloomberg, Blinken's latest Middle East mission shows more labor than payoff. And if you see mainstream media giving up hope, you know that things are truly getting bleaker. And the big problem is Blinken losing control and influence over Israel. US pressure on Israel isn't working. Even getting a humanitarian pause now is becoming very difficult. Blinken is on a one-man mission that satisfies no one, right? The Arab states wants a ceasefire, Israel doesn't want a pause, US influence looks like it's crumbling and crumbling fast. Israel, they kind of have a blank check for America and Netanyahu. He is cashing it in. Almost immediately after Blinken visited Israel, Netanyahu went on TV and rejected the idea. I made clear that we are continuing full force and that Israel refuses a temporary ceasefire, which does not include the release of our hostages. And talk about adding insult to injury. Even Joe Biden now is asking Israel for a pause in the Gaza fighting. I think he knows the stakes at hand, right? If a ceasefire doesn't happen soon, or at least a pause, the entire Middle East will start losing respect for the United States. China is already starting to make friends and grow their influence in the Gulf. Russia is also turning against Israel to side with the Arab world. They are getting a stronger foothold in the region as the US loses influence. And if America doesn't broker some sort of deal with Netanyahu and do it soon, things will spiral out of control. And here's how bad things are truly getting. Remember the strike that hit Lebanon a few days ago? Well, that is inflaming things in the country. In a report by Reuters, a Hezbollah lawmaker has said the resistance will respond double to any aggression that targets civilians, and it hasn't yet shown all its weight. This is the immediate danger the Middle East is in, an endless cycle of escalation and retaliation. America has to defuse the situation somehow and do it fast. They must broker a deal. And if we zoom into the situation in Israel, things are looking extremely messy, it's looking extremely volatile. As Israel continues their operation in Gaza, we have multiple reports of attacks all over the country. There's those small orange circles that are littering the map on the left. Then on the right side, we can see a string of attacks along the Israel-Lebanon border as well. We are on the brink of a multi-front war, and this has the potential to escalate out of control. There are 2 aircraft carrier strike groups and a nuclear submarine nearby, so any response from America will be legendary. And that's why I find it very incredulous that the market isn't pricing in this risk. Stocks are back above the pre-October 7 levels, which simply doesn't make any sense. The market is factoring the Federal Reserve's pause on interest rates more than this geopolitical disaster. But let's talk about the diplomatic front because things are looking even bleaker there. Israel isn't listening to the United States, which is very worrying. The White House is now scolding Israel and giving them a warning. During Blinken's Middle East tour, he told the world that Israel wouldn't be interested in occupying Gaza after the war. But moments later, Netanyahu gave America the shock of their lives. He literally came out saying that Israel would take responsibility for Gaza's security for an indefinite period. And how long will that be? We have no idea. Will it be for 1 month, 1 year, or 5 years? So just imagine the horror on Blinken's face the moment Netanyahu said that. He probably fell off a chair. Israel also reaffirmed there won't be a ceasefire. Listen to this. There will be no ceasefire, general ceasefire in Gaza without the release of our hostages. As far as tactical little pauses and our here and our there, we've had them before. So a ceasefire is off the table for now, until the hostages are released, and the most we'll get are hour-long pauses. And this is freaking America out because Israel's stance ramps up the threat of escalations from Iranian proxies. Almost immediately, Blinken hit back at Israel's commands. He came out saying that Gaza must not be reoccupied by Israel but be governed by the Palestinians themselves, essentially a two-state solution. Gaza cannot continue to be run by Hamas. It's also clear that Israel cannot occupy Gaza. This is a clear message from the United States. America knows how volatile the situation is. If Blinken doesn't publicly reject the idea, this could spark an even bigger crisis in the Middle East. I mean, just look at Blinken's face. He looks like a broken man in the recent G7 meeting. It's like he has seen a ghost. The Arabs aren't listening to him and Israel doesn't take him seriously. America has to take steps to defuse the tensions in the region, and that means getting Israel to agree to the bigger picture. But that won't be very easy. But let's talk about the war spending for a bit. This financial Halloween story isn't over yet. In fact, I think we are heading towards a spending apocalypse and economic Armageddon might be coming soon. And we know that war is expensive. It adds more government debt and channels money away from the real economy. And whether you support war spending or not, it doesn't really matter because it's coming real soon. In a big update, the US Senate has blocked the Republican bid to aid Israel and not Ukraine. And I believe there's only one way to interpret this, and that is the US government wants to send money to both Israel and Ukraine. And it doesn't matter if the Republicans want to stop sending aid to Ukraine. The Senate is controlled by the Democrats and Biden has veto powers. So Mike Johnson can try to push his agenda, but it'll get blocked by Biden and friends. It won't just be $14 billion going to Israel, but more money heading to fund Ukraine as well. We shouldn't be surprised if Biden gets his $100 billion request. And let's look into who will be the biggest beneficiaries of this military aid. In a Bloomberg story, Biden's military aid request for Israel would double Iron Dome arsenal. The funds will include 100 Iron Dome launchers and 14,000 interceptors. Companies like RTX or Raytheon will be benefiting from a potential $4 billion budget for missiles. Now, I personally don't hold defense stocks, but if you do and the budget gets approved, prices might go up. The more escalations happen, the more war spending gets justified in Congress. And this latest piece of news could get approval to jack up the budget even further. According to the Pentagon, the US has breaking intelligence. They believe Russia's Wagner Group may be sending air defense systems to Hezbollah. Obviously, we have no idea what goes on behind the scenes, and Russia and Wagner would definitely dispute this. But let's just assume it's true. If this gets deployed, just imagine the level of escalation risk this poses. What if it takes down a US fighter jet, right? Then the scenario will be unthinkable. How will America retaliate? Will they start to mobilize their carrier strike groups? So things are really heating up and war spending is on the brink of flying up. There's now an epic tug of war in the US Treasury market. On one hand, we have investors running to treasuries as a safe haven, a flight to safe haven. Then you have government spending threatening to spike yields back up if the Middle East crisis erupts further. According to the IMF, US government budget deficit is on track to exceed 8% of America's GDP. And let that sink in for a moment. And that's why Q3 GDP hit a mind-blowing 4.9% recently. It's the creation of all this debt that's propping up the US economy. So the bias is there for war spending to accelerate and more bonds to be issued. The economy is now trapped where if you slow spending down, the tide will go out and the swamp monster will reveal itself. A recession would most definitely come. And that's why I believe Biden will get his funding request approved. Maybe not the full $100 billion, but the majority of it. It might be way more than just $14 billion for Israel. More money is needed to keep the economy chugging along because the numbers are looking really bad. The yield curve inversion tells us that we should be heading into a recession. However, GDP is sky high thanks to government spending, but there's another indicator that's flashing red, and it's the unemployment numbers that's telling us something is really wrong in the economy. So here's the problem. Unemployment has flown up and it is triggering the ultra-reliable sum rule that predicts every recession. And here's the rule. If the 3-month average of the unemployment rate is 0.5% more than its low in the previous 12 months, the economy is in recession. And let me make it simpler for you. This is the chart of the US unemployment rate. We hit a low of 3.4% in January, but it has risen to 3.9% in October. So the longer unemployment remains at 3.9% or higher, the bigger the confirmation of a recession. Remember that government spending is already sky high, but unemployment is still rising. Knowing this, if you were the Biden administration, would you dare to scale back on war spending now? And here's one chart you must burn into your brain, into your mind. The US Q1 GDP was 1.1%, but out of this growth, 0.21% came from defense spending. Defense accounted for 1/5 of US GDP growth in Q1, which is quite shocking. So just imagine if Congress rug pulls Ukraine, right, and they stop giving financial aid. That will also negatively impact US economic growth. So we must prepare for more bonds to flood the market and more debt to accumulate in the system. I won't be surprised if Q4 GDP hits 4.9% or even higher. But let me know what you think in the comments below. Can America get the Middle East in order? And will war spending escalate even further? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.
Alright, so there's a ton of things that happened to the economy this week. A new report just came out about the main lifestyle of Americans, and 62% of the US is now living paycheck to paycheck. Also, the US debt is getting worse, US spending is out of control, inflation is still too high, and the new interest rate was just revealed. But first things first, let's talk about inflation. It's how the government measures how fast the speed of prices is going up.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
Now before I unpack this,
Do me a favor and smash that like button for Andre's video so we can inflate his view count like the Fed inflated inflation.
that's just how I like to use AI. I have become Fed, the destroyer of worlds. Now so far, of course, we know that the price of stuff we buy is not coming down. And the most important one that everyone is waiting for is shelter. things like rent. And that went up 0.6%. And it's not just rent, it's literally everything else as well, including energy, food, and gas prices. So all in all, when factoring in any pay raises that someone might have got at their job, thanks to inflation, their real wage growth was negative by comparison. So it looks like prices aren't coming down, and they probably never will unless we get another round of layoffs or a recession. The only good news about inflation is that prices are growing at a slower rate, closer to what the Fed actually wants, which is 2%.
We cannot yet know how long these lower readings will persist or where inflation will settle over coming quarters. And the full effects of our tightening have yet to be felt.
Next up this week is the interest rate, specifically the federal fund rate, which is the cost for banks to borrow money from each other. And this week, the Fed got together to decide what they were going to do, and the new rate is going to stay exactly the same, which is also why the stock market went up this week, and I'll explain why this happens later in the video. But arguably the worst news is that the US is spending money out of control, and it's borrowing to do it.
But we are spending like drunken sailors, okay?
So let me explain exactly what's going on, and let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the breakdown. I'm going to talk kind of slow in today's video so you can hopefully understand what I'm trying to explain, because it's about to get extremely complicated. Now, you might have seen this article recently that the 60-40 just had its worst year in generations. And that sounds terrifying. So what the heck does that mean? So when our parents learned about investing, they learned about something called the 60-40 principle, which taught them that for every $100 they had invested in their portfolio, 60 of those dollars should be put into an ETF like VU, which represented the stock market's S&P 500, and the other $40 would be placed into bonds. That way, when the bond market was down, stocks were up. And when stocks were down, bonds were up. Hopefully this volatility would balance itself out. It was their buy the dip strategy. But that strategy just had one of its worst years ever. And why this happened is a really good question. Now, the short explanation is bad timing. But the long explanation, I'll let Papa J. Powell take over and explain what he's doing to interest rates right now.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
So Jerome Powell says that they are still reducing securities. So that's the bad timing part. So what this means is, remember, because of the pandemic, we flooded the economy with trillions of dollars in stimulus. They did that by buying specific assets, and that was called quantitative easing. But that created inflation. So now they're doing the opposite. They're doing quantitative tightening. And the way they do that specifically is by selling off two assets out of their portfolio. And that's treasury bonds and mortgage-backed securities at the rate of $95 billion a month. But what the heck does any of that mean, and how does that affect us? It affects us because, think about it like this. What happens when someone is a net seller of something they control a lot of? That something goes down in price. So when the Federal Reserve sells its bonds out of their portfolio, it lowers the price of those bonds, which is exactly what we're seeing happening to the bond market. It's losing a ton of money. What this means for the rest of us is that the cost of buying a new car, or buying a new house, or opening a new credit card, or pretty much anything to do with borrowing money has gotten really expensive, which is also why our debt levels are pretty much near record highs. Therefore, hopefully discouraging people from going out and spending more of their money, lowering inflation. And that's the theory behind it. But the second thing that happens is that corporations can't borrow money either. So they play defensively, stocks go down in value, layoffs start to happen, and that's not very good. So now you have this perfect storm where stocks will go down in value, and because the Fed is selling off their bonds, it depresses the bond market as well. So that's why this seesaw is completely broken, and that's the long explanation of what the 60-40 principle is based on and why it had its worst year in generations. So I hope all that made a little bit of sense. It was just bad timing. Thanks to the pandemic, we created stimulus, which created inflation, so the Fed had to raise rates to fight inflation, which is great for bonds, but not good for stocks, and then the Fed eventually had to sell off their bonds, which isn't good for bonds, to drain the liquidity, and that's where we are today. If that didn't make any sense, just press the J button on your keyboard to go back 10 seconds a couple times, and you'll still probably be confused. Now let's talk about what's happening this week, because the Fed paused interest rate increases. And that's why you're seeing articles like this. The stock market is rallying, it's going up. And why this is happening is because the stock market's like, thank you for slowing down our competitor. If you keep raising rates, there's no reason to invest your money in the stock market when you're guaranteed a 6% with bonds. So that's why the stock market is excited and why it's going up. Now, the second thing that's happening is why you might have seen articles like this, encouraging you to buy into the bond market because it's about to go up. Why are these companies doing that? How do they know? Do they have a crystal ball? Are they shills for the government? No, the real reason why they think bond prices are about to go up is because anytime the Fed stops raising rates like they just did, and like they did way back in July, they haven't raised our rates, that at some point it makes sense that they'll start to lower interest rates. Well, when the Fed lowers rates, bond prices do go up. And here's how it works. Here's how you can think about this. Let's say that you buy a bond today that's yielding 5% interest and it has a maturity of 3 years. So after 3 years, you get all your money back plus the interest. Well, let's say you buy this bond and you hold on to it for 2 years. And let's say in 2 years, the Fed will have already lowered its interest rate to say 3%. Well, now your bond that's paying 5% has a premium on it. If you were to sell that bond on the secondary market before that maturity date, then you would get more money than what you initially paid for it because it's paying a higher interest rate. And that's how this mechanism works of whenever interest rates go down, bond prices go up. And that's why people speculate that right now is the time to buy into these bonds because their prices will go up because the Fed will lower rates. Now, I did simplify this a little bit though, because there is a difference between bond funds and individual bonds, but we'll skip that part. So then the question is, when will the Federal Reserve lower interest rates? And that's the million-dollar question that no one knows the answer to. But the theory is sometime in 2024 or when we go into a recession because they'll have to lower rates to pull us out of it. But for now, there is one more potential rate increase this year. The next time we'll find out is December 13, 2023. But so far, the odds are in our favor that the rates will stay the same. But it can also change as we get closer to the 13th. Now, what I think is kind of funny though, is that if you say interest rates are kind of high right now to someone who was alive in the 70s and 80s, they'll be like, "Ah, you young whippersnappers. Interest rates were way higher back when I was younger." And that's true. Interest rates 40 to 50 years ago were in the double digits. But the difference between now and back then is that back then, the national debt didn't look like this, and the price of a starter home didn't look like that. And when you combine what's already a highly valued market with our current debt and our interest rates, you get a country that needs to borrow money to pay for all the money that it's borrowed. It's like imagine taking out a credit card to pay for all your other credit cards. If the US was a person calling in to Dave Ramsey asking what it should do, Dave Ramsey would be losing it right now. He wouldn't have it. He would be telling the US to get on rice and beans.
No. You have a crisis. No. You are on beans and rice and beans. No vacation. You will not see the light of day. You will work like an animal.
Because here's what happened recently that I didn't see a lot of people talk about that's kind of a big deal. The US Treasury borrowed $776 billion in the last quarter of this year, and they're expected to borrow over $800 in the first quarter of next year to pay for Treasury things. And Treasury things are things like paying the interest rate on Treasuries. Because think about it, when you earn interest from a bond, who pays that interest? It's the Treasury, which now has to borrow money to pay its investors. And if the government is running on a deficit, if it's spending more money than it brings in tax revenue, it has to borrow money to pay us back. So we really are spending like drunken sailors, which is ironic considering it's coming from a drunken miller. I'm sorry. But the point I'm trying to make is that when the US borrows money, it does that by creating bonds. That's why we're at a record high in issuance of bonds, because we're borrowing at a record pace. And the problem with borrowing money is that we have to raise interest rates to entice more bond buyers. And when rates are high, it can drown out innovation and destroy the stock market. And why would companies borrow money at these interest rates? And why would we risk our money in the stock market when bonds could potentially pay us even more? It's a perpetual problem, and I don't think I'm smart enough to figure out where this problem eventually leads, but I don't think it's a good thing for either consumers, investors, or the country as a whole. But I'm probably wrong and I have no idea what I'm saying. I'd love to know your thoughts though. I love macroeconomics. I think it's so complicated and so fascinating, and I don't fully understand it, but the more I learn about it, the more confused I sometimes get. So hopefully together we can get unconfused, one video and one smashing of the like button at a time. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with a spreadsheet linked down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday and Friday, sometimes a Wednesday. See you soon. Bye-bye.
The US government is borrowing more than ever before in history. The US national debt is hitting new record highs literally every single month. In the past 4 months, the US borrowed $1.5 trillion, and it plans to borrow another $1.5 trillion over the next 6 months. But there's a bit of a problem. While the Treasury Department is issuing more and more long-term debt, fewer investors want to purchase it. It's no longer in demand. Even Ken Griffin, the CEO of Citadel, said in an interview this past week that the United States, and this is a direct quote, is spending like a drunken sailor. Something quite shocking happened. On Thursday, November the 9th, the US government attempted to borrow $24 billion by selling its newly issued 30-year treasuries. The auction did not go as planned. It went poorly. What's even worse, a day later, Moody's lowered US credit outlook from stable to negative as the result of, quote, political polarization and irresponsible government spending, or using more politically correct terms, growing deficits. The US AAA rating is at risk. The credit agency said continued political polarization within US Congress raises the risk that successive governments will not be able to reach consensus on a fiscal plan to slow the decline in debt affordability. The disaster of an auction speaks for itself. Saying that it did not go as planned is probably an understatement. The United States government could not find those who were willing to buy its debt. Potential investors needed the rate of return to be higher to compensate for the risk. Issuing debt and selling it helps the United States government raise money to finance its deficits. They are addicted to spending. Those who purchase U.S. debt are our lenders, so there have to be lenders willing to lend, and there are fewer and fewer of those. In order to get enough lenders, the government had to offer a higher interest rate than originally planned. Historically, the U.S. Treasuries have been the safest investment because it's backed by the full faith of the U.S. government that, in theory, would never default. So because of this immense trust in the U.S. government, selling debt has never been an issue until now. If you're trying to sell something and nobody wants to buy it, what do? You lower the price, right? Or if you issue debt, you increase the rate that you're willing to pay to those who are holding your debt. So in order to find enough buyers, the rate of return to investors had to increase substantially. As you can see on this chart, there is that spike at the end of the week. The issue with that is that the higher the interest rate, the more we, the United States public, will end up paying in interest costs to service that debt. It's absolutely unsustainable, and it is a path to a complete self-destruction. Maybe it wouldn't have been such a big deal about 10 or 15 years ago, but the world has changed dramatically, and as the result of growing risks associated with investing in the US debt, buyers want to be compensated better. The Wall Street Journal reported that the 30-year US Treasury yield climbed above 4.8% on Thursday from 4.6% the prior day, after a sale of $24 billion in bonds received far less demand from investors than the government is used to. Here's a much better way to describe what happened. Barron's said the auction went, quote, as badly as it could, and, quote, government had to entice investors with a premium over the market to buy their debt. On Thursday, primary dealers had to step in and buy much more than they typically do because those countries that once bought the highest volumes of the US debt are no longer buying it. China, Russia, Saudi Arabia, and Japan are not purchasing US Treasuries. They used to be the biggest buyers as recently as just several years ago, but that's not the case any longer. There are 2 videos on my channel where I discuss this in great detail. I will link them below for you if you're interested. If you're just hearing about this and you're not sure what it means, I highly recommend you watch those 2 videos for more details and the background. Primary dealers, these are the big banks that buy whatever portion of a US Treasury auction is not purchased. They bought 25% of the entire Treasury debt issuance this week. According to reports published by BMO Capital Markets, typically primary dealers buy around 10%, so they had to step in and buy nearly twice their typical volumes just a couple of days ago to make up for the lack in demand. A day after the auction on Friday, Moody's cut U.S. credit outlook from stable to negative. The credit reporting agency pointed to political polarization as well as increasing deficits as the main reasons. Moody's specifically emphasized higher interest rates as a risk with rising deficit spending. This is happening as interest rates are rising and the United States is issuing trillions of dollars in debt. that it has to, of course, somehow manage to service later on. Moody's says, listen, we actually don't think that this is going to end well. We expect fiscal deficits to remain large. We don't think the United States fiscal policy is great. It is self-destructive. It does not promote financial recovery or strength, and consumers are going to be hit hard because the banks are tightening lending. Whether the United States will lose its AAA rating remains to be seen, but it is clear that it may be on that path already. As the United States plans to issue another $1.5 trillion of debt over the next 6 months, will there be lenders? If this continues, eventually an auction like this will fail. Lenders may not want to buy at any rate. Investors are already staying away from 30-year government securities. Those are supposed to be the safest ones. If there are no lenders, the Federal Reserve would likely eventually have to step in to save the day, but at the end of the day, it would only delay the inevitable. Thank you for taking the time to watch this video. Thanks for joining me today. Subscribe to my channels on Rumble and YouTube. You will find all of my social links in the description below. Find me on Substack, where among other types of content, you will see a weekly newsletter with the key events and economic data that will help you stay up to date on the most important news and make sense of what's going on. And I will see you in my new one soon. Take care.
And everyone needs to pay very, very close attention to this because it's going to rewrite capitalism in America. When you're looking at what they're doing, how they're planning on collecting, it's really shocking. It's frightening, really. They're using chatbots and ChatGPT-like integrations, AI.
AI could help the IRS collect billions of dollars in taxes and catch those who fail to pay.
Looking for similarities and patterns in your spending, in your business, in your lifestyle to try to extract as much capital and tax out of you as possible. I believe having a great accountant in 2024 and 2025 will be one of the greatest investments you can possibly make. So really, really look into an accountant if you have a business that, possibly could raise red flags. Pay very close attention to this. I'm going to break it down for you. I'm going to show you the facts. Please hit the like button. When you hit the like button, YouTube will share this content to educate the people. That's really happening in America in the new normal. And if you'd like to fix your credit to position yourself for what I think is going to be the greatest wealth transfer of all time, it started in 2020. It's been ramping up over the last couple of years. Now things are about to get real. 2024, 2025, we're going to see a fire sale of assets, I believe. So if you need help fixing your credit, we'd love to help you. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to greatcreditfast.com. Click the link in the description just below this video. Schedule a free strategy session. Take a look at this. So from chatbots to audits, how the IRS will use AI this tax season. The IRS has plans to increase its use of AI. Here's how the agency will do it and what it could mean for taxpayers. As part of the IRS efforts to increase enforcement for wealthy taxpayers, the agency is implementing the use of artificial intelligence to identify possible violations of high-income tax returns. Now, they say it's for wealthy taxpayers, but I don't think you believe that. I certainly don't. I believe they're going to be doing this from a mass market perspective. Wealthy taxpayers have tight and strong legal teams. Everything is buttoned up. When you have the everyday American, when they get an audit or a piece of mail from the IRS saying you owe us $500, $1,000, are they going to hire an accountant to go after them and try to go through everything, or are they just going to write the check for $500 or $1,000? I believe they're just going to write the check, right? And so what's going to happen is we're going to start seeing a lot more of the middle class starting to get these letters, I believe, in 2024. We will start to see patterns and trends and activity that we can link with tax evasion that we couldn't previously. So they go on to say that they're going to be using the AI to crack down on so-called wealthy tax cheats. But here's how this works. This is the new breakdown. If you make, let's just say for easy math, $75,000 per year, $75,000 per year, you would fit here 22%, right? Even if you make $11,000 a year, you still have to pay 10% tax. I mean, that's crazy. But 22% tax, $75,000 a year. That's if you live in Florida, if you live in one of these locations. You live in Florida, Texas, Tennessee, South Dakota, Wyoming, Nevada, right? If you live in one of these areas, then sure, it would just be the 22%. But and it would look like this, just to break this down to make it very simple and easy. $75,000 a yearly income, tax bill would be $16,500. So the net monthly income after taxes would be $4,875, right? And let's say you're renting for $1,500. You have utilities and Wi-Fi, about $150 combined. Cell phone, $100. Gas, $50 per week, right? $200 per month. Car payment, $729, which is, believe it or not, the average car payment in America, right? $729. Then you have a car payment, right? Car insurance for $150, which is extremely cheap. Credit card, say $300 monthly payment. Student loans, $460, which is the average right here, $460. Then you have food, $50 a week. I don't know how one would, or $125 per week. I don't know how one would be able to live on $125 per week at the grocery store anymore. If you go through a Chick-fil-A drive-thru or a McDonald's drive-thru, it's $15 or $20, right? You have to eat a couple times a day. So, I mean, at the end of the day, at the end of the week, you'd be spending much more than $125 per week, right? But if you added all of those total expenses up, it's $4,100. That's if you live in one of those 6 states. But if you live in any other state, let's say even for example, Alabama, which is relatively in low tax base, 5%, you would still owe, right? You'd still have to pay Alabama $312 a month. So you would save at the end of the month, if you lived in Alabama, $533. If you didn't, you lived in one of those other 6 states with 0% taxes, it'd be $775 per month is what you would save, right? $775. That's if the cost of living does not continue to rise. And that's considering making $75,000 a year, right? $75,000 a year. And that's also, you're not buying any clothes, you're not going on any vacations, you're not eating out, you're not doing anything. You're saving, $700 a month, $800 a month. So you start to look at what this is going to mean. It's going to mean this AI is going to, I believe, start cracking down on a lot of small businesses, a lot of PPP loans, a lot of the stimulus. They're going to start cracking down on everything from the last couple of years. And what I think is going to likely happen is we're going to start seeing a lot of people have a lot of tax problems. That's what I think is going to happen. When you look at where household debt and credit report, this credit report is at, it's pretty shocking. So now we just hit the highest debt in American history. And this just came out, right? So household debt rises to $17.29 trillion, led by mortgage, credit card, and student loan balances. Total household debt rose by 1.3% to reach $17.29 trillion in the third quarter of 2023, according to the latest quarterly report on household debt and credit. Mortgage balances increased to $12.14 trillion, credit card balances $1.08 trillion, student loan balances $1.6 trillion, auto loan balances increased to $1.6 trillion, including upward trajectory seen since 2011, right after the GFC. Other balances, which include retail credit cards and other consumer loans, were effectively flat at $0.53 trillion. Delinquency transition rates increased for most debt types except for student loans, well, because student loans are paused. But when you look at this, credit card defaults were at 9.5% in the eve of 2008, right before the GFC. Guess what they are right now? 9.4, right? 9.4%. We're basically there. So when you're looking at this, you're like, okay, well, consumers, they look like they're going to be in trouble, and the IRS looks like they're going to really start ramping up collections. What is happening with the auto loan crisis? Where are the everyday American consumers with their vehicles? Well, Cox Automotive, a leading auto organization, predicts that 1.5 million cars will be repossessed this year. It's 300,000 more cars than in 2022. So the big question is, if that's what they're predicting this year, what would they be predicting next year when all these student loans begin to kick in, right? Because many people are not paying close attention to the student loan crisis. This is a massive, massive problem. The average person in America, 2 out of 3 Americans don't have $400. And if the average payment every month is $460, it's going to mean millions and millions and millions will not be able to pay. They won't be able to pay. And so what does that mean? After 90 days, it goes on their credit report as delinquent. So if it started October 1st, coming January 1st, which would be the 90-day period, you're going to see millions and millions and millions of people having these late payments and charge-offs and all these different issues that have occurred during the holiday season all start to hit their credit report. And so when you're looking at all these problems added up, what we're going to likely walk into is the liquidity crunch, a credit crunch, and a tax crisis that is going to be sweeping through America. If you look at the need money chart, right, just as Google Trends starting from 2004, and you look at this move that just started happening even more so the last year, it's really starting to pick up. People are really starting to look for ways in which they can get access to liquidity and access to money. Credit card balances set another record Q3 of 2023. American total credit card rose again during the third quarter of 2023 to an all-time record of $1.080 trillion, according to a report recently released by the Fed. These balances have soared an incredible 40% since the first quarter of 2021. Now, here's my suggestion. If you're looking at all this, what I would believe is the way to look at this is an opportunity, really. It's an opportunity to speak to an accountant, to invest your money well, to have the right write-offs, to have the right structure, everything in place now to get ahead of this, to get in front of this problem. Because what you don't want to do is what everybody else does. What everybody else does, they ignore the problem until it becomes a real big issue. If you face it head on, you're going to be able to get in front of the problems. So what I think is going to happen is, as I mentioned before, a liquidity crisis, credit's going to tighten up, you're going to want access to money. You're going to want to be able to have the right write-off. So getting a really good accountant now would probably be, time well spent and money well spent. Having your credit score in line, 740, 750, 760 and above, probably a very good idea to do that. Getting out of high interest rate consumer credit card debt, a very wise idea. Putting yourself in a position to where if you were a bank, you would want to lend you money is probably a very smart thing to do. Because when we walk into 2024 and 2025, a lot of people are not going to be prepared for it. And what do people do when they walk into a crisis? They panic, they make emotional decisions, and they sell. And that's what I think we're going to walk into. I think we're going to walk into a situation where a lot of people, a lot of small businesses are going to be forced to sell off assets. And you, as an investor and entrepreneur, you're going to want to be out there, picking up assets and putting yourself in a stronger position to build a moat of safety around yourself and your family in some very uncertain times. What do you think about this situation? You think we're walking into a scenario where we're going to see massive audits and we're going to start to see a whole different type of American capitalism? Drop below, we'll have a conversation about it. And if you want to fix your credit, we'd love to help you. Love to give you a free consultation on my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com. Click the link below in the description, schedule a free call, and I'll see you next one.
The old US playbook of divide and conquer isn't working very well in 2023. In our lead story today, we have a tale of overcoming differences and countries doing what's best for themselves. China and Australia look for mutual benefit after years of animosity. Australia's Albanese met with President Xi on his first visit Beijing since 2016, and this will pay huge dividends. It's like the Aussies suddenly had an epiphany and realized that, hey, what are we doing? It doesn't make sense to torpedo our own economy. China is our largest trading partner. And listen to what Xi Jinping said during the meeting, that the two countries had no fundamental conflict of interest and could become mutually trusting and successful partners. And this is a big step since relations went to hell during the term of Scott Morrison. Australia was the first country to ban Huawei from their 5G network, which came as a complete shock. Another example was the government blocking a Chinese fund from investing in a rare earth producer. Canberra blocked the bid of a China-linked investment into their mineral supply chain on the grounds of national interest. It was restrictions like this that caused China to slowly divest away from Australia, right? Why put your money to a country where you're not welcome? Might as well invest in the BRICS countries like Russia or the Middle East. And things got so bad that Chinese corporate investment in Australia fell 5 years in a row. It went from over $11 billion in 2016 to under $600 million by 2021, which is an insane drop. Investment dropped by over 90%, which has impacted the Australian economy. In a story by ABC, Chinese investment is crucial to Australia's energy transition. They're trying to build new renewable energy networks, including solar panels, wind towers, and batteries. But there's a big problem. You need a ton of raw materials. While Australia is the world's biggest supplier of lithium for batteries, to retain that spot, they need to develop more mines. Over 400 new mines globally will be needed just to supply EVs with batteries. But developing mines takes a lot of money, expertise, and risk-taking. And this isn't your average venture. This is where Chinese investments comes in. This is money that isn't afraid of taking risks. In 2022, mining accounted for 86% of China's investment flows into Australia. That is going to projects like lithium mines. And this is exactly what Australia needs to remain the top exporter of renewable commodities. And that's why China and Australia are natural trading and economic partners. But why did this take so long? Well, maybe it's because of the influence of the G7. And we know the rhetoric from the US and the UK is centered around decoupling or de-risking from China, right? It framed China as the world's enemy, ready to eat up the Indo-Pacific. Take this headline from CNN, for example. Australia, the UK, and the US are joining forces in the Pacific, but will nuclear subs arrive quick enough to counter China? And it's this kind of fear-mongering that made Australia listen to the US. It kind of shows some kind of grand plan to deter an attack from China that's imminent. They believed and they peddled the strategic interests of the US, which mainly benefited, guess who? The United States itself. And this is where we need to talk about that AUKUS nuclear sub deal. That was a great economic victory for the US, but a huge financial drain for Australia. The former Prime Minister of Australia, Paul Keating, called the submarine pact the worst deal in all of history. According to him, it's the worst international decision and called it seriously unwise. But here's where things get really interesting. He revealed the true intentions of the deal, which was to preserve US hegemony in East Asia. Listen to this. Albany screwed into place the last shackle in the long chain which the Americans have laid out to contain China, and that the great sin China committed in the eyes of the West was developing its economy to equal the size of the United States. Keating revealed the true intentions of all this China decoupling or containment talk. It's basically to ensure America stays the unchallenged number one superpower in the world. But let's analyze how much the AUKUS deal will cost the Australian government. The program is going to cost Australia up to $368 billion over the next 3 decades. That's a lot of money. It will be used to buy 8 US Virginia-class nuclear submarines built by General Dynamics in the United States. So we can already see the big beneficiary of this deal. It will be the US. The big question is, what will this cost Australia financially? Because if you spend $360 billion on nuclear subs, that is money being taken away from other parts of the economy. It's a zero-sum game. So let's put the submarine spending in context. This chart shows us what other things Australia could spend the money on. This is using the lower bound of 270 billion Australian dollars, and the figures here have been converted to USD as well. In the first decade, Australia is expected to spend at least 58 billion US dollars on the deal. That is almost half the budget for transport infrastructure and almost all of school funding. But it gets crazier. $58 billion would be enough to raise the carer payment, Medicare rebate, and rent assistance all at the same time. So it's a huge burden to spend money to defend yourself against an invisible enemy who is your biggest trading partner. You'll also be aggravating China, which is very counterproductive. This is money that could be used to build up the Australian economy. And the only beneficiary of this will be the US military-industrial complex. Those are the true winners. The AUKUS deal enriches the US financially and enhances their Indo-Pacific presence. So in a way, from the American perspective, it is a very smart move. But things are changing. It's important to understand the significance of Albany's trip to Beijing. It's been 50 years since the first visit by Australian PM to China, and this shows a big reset of relations, especially from Australia. Albanese is taking a very practical approach with China, and it's all about developing his economy. Australia and China will always have differences, but the main agenda here is to cooperate and build up each other's economies. And how can Australia benefit from China? The answer is very simple. Enhance trade with Beijing when the rest of the West is starting to back away. Chinese exports fell by 25% to the United States in the first 6 months of 2023. This is much more than a global slowdown. It's a deliberate decoupling from Washington. And this is where Australia wins. China exports deflation because their goods are becoming cheaper as the dollar strengthens, while Australia has an inflation problem going on right now. We can see Australia's CPI rate is still astoundingly high compared to the US, Europe, and even Germany. It is at 5.4% in September and up by 1.2% from the previous quarter. The longer inflation persists, the RBA has to raise interest rates even higher. And we said before that Australia has to hike rates because inflation is far from over. And guess what? The RBA has hiked rates by 25 basis points to 4.35%. According to Bullock, inflation in Australia has passed its peak, but it is still too high and is proving to be more persistent than expected a few months ago. This is where improving trade with China comes in. The key here is to drive more trade with China. When Australia sells more stuff to China, they invoice in either US dollars or Australian dollars. And since the Fed started its rate hikes, the Australian dollar has crashed by at least 12% to the dollar. And this makes global imports to Australia more expensive because almost everything is still priced in the reserve currency. It is a direct contributor to their inflation crisis. And that's why trade with China is beneficial to the Australian dollar, right? If China pays in USD, Australia now has a bigger pile of greenbacks to prop up their local currency. Conversely, if it's bilateral trade and China pays in Australian dollars, it will directly benefit Australia as well. There will be more demand for the Aussie buck to buy commodities. So either way, it's a win-win proposition. And because of the previous trade curbs, there are now a ton of revenue to play catch up with. Australia eyes 3 lost years of commodity sales to China. From 2020 to 2022, the export revenue affected total $31 billion, which is a huge amount lost. Australia is an export-based economy. They need to sell their coal, iron ore, and food exports to other countries. And the biggest buyer in Asia Pacific is China. there's no point shipping stuff all the way to the West because it just increases the buying costs. And just take a look at the fall of coal and copper exports to Beijing. It took a big tumble over the past 3 years. Australia lost up to $12 billion a year of revenue from China at the peak, and this was money just next door. So if Australia mends ties with China, we'll see export levels of commodities start to recover, and this helps to keep inflation in check. So it's good economics for China and Australia to just work together, right? But there's an even bigger reason why countries love working with China. Well, it's because China is non-interventionist. They are all about business and they couldn't care less about how you run your country, which is a big departure from what the US does. The US playbook ties economic interest to their foreign policy, but China is different. They just want to trade and make money. And this is why China managed to broker the Iran-Saudi deal that restored diplomatic ties. And here's why these two rivals decided to accept China's deal to restore relations. The agreement affirmed the respect for sovereignty of states and the non-interference in internal affairs of states. The same goes for how China conducts their economic affairs. Australia partnering with China will also make it easier for them to sell more exports to the rest of BRICS as well. By 2024, BRICS will consist of 11 members, and additional 6 members are expected to join the bloc. In total, they represent almost 30% of global GDP, and in terms of purchasing power parity, they have already exceeded the G7. If you look at the list carefully, you can also see a lot of these countries are developing nations. These are places that need a ton of commodity imports like coal, iron ore, and food, stuff that Australia can export. So by engaging with China more, Australia will likely find even more opportunities to trade with the rest of the BRICS nations. It's geographically closer than exporting stuff all the way to Europe, right? You can sell more for less. So if we look at Australia's balance of trade, it's obvious how much money they are earning with China. Beijing isn't just their biggest trade partner, but a cash cow for Australia. In September 2023, China exported only $6.6 billion to Australia. In contrast, they imported over $12 billion worth of stuff from down under. So China's negative trade balance of $5.6 billion is Australia's trade surplus, which is very important for a net exporter country. Having a bigger surplus means a country becomes richer. They can add more money to their reserves or use it for social programs like rent assistance and disability. So the more Australia trades with China, the more stuff they sell, the stronger their economy will become. Even though China imposed trade curbs back in 2020, their imports from Australia are still strong thanks to iron ore demand. But with trade relations warming, we can expect to see the tariff of block goods exports start to rise. And this means by 2025, unless we have a global recession, Australia's exports to China could increase by 5%, 10%, or even 20% above the baseline. This helps them bring inflation down and even escape a potential recession. So it's quite a positive sign for Australia if relations improve. And we can see the different approaches countries are having with China, right? What's funny is how Europe is decoupling from Beijing, leaving more opportunities for Australia. Take Germany for example. Their economy is shrinking, with GDP falling by 0.1% in the previous quarter. They don't have access to cheap energy, and they are trying to cut away exports from China. And what does this insanity do? It destroys competitiveness. German products simply cost too much to manufacture, which means consumers have to pay more. Well, they won't pay more during a recession. However, Australia is taking a different approach. They are working with China because it benefits their economy, plain and simple. By exporting to Beijing, they earn more money, and by importing from China, they get cheaper products. They actually import deflation. So Albanese realizes the obvious that there's no good reason to decouple. During a press conference, he said this: China is a market of 1.4 billion people. It is an economy that's growing faster than the global average, and this is an economy that's complementary in many ways to the Australian economy. So there are wins to be had. Even though Australia might be having some headwinds right now, long term, it is looking rather bullish for them. And this might be the single best decision made by a Western country in 2023. But let me know what you think in the comments below. Will Australia start trading more with China? And has the US lost this fight? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.
huge.
So Japan just declared that it's ending its negative interest rate experiment that it started 7 years ago. And the theory is that it will have an impact on the US economy, on our debt levels, and our interest rates. Now this gets insanely complicated, but I'll try to keep it simple because this story technically started 7 years ago. Picture it, the year was 2016. It was the year of the presidential elections, the year the United Kingdom voted to leave the European Union, and it was a pretty crazy year. At the same time, the US economy was starting to heat up, and the Federal Reserve was worried that the US inflation would grow at a faster rate than what they want, which is 2% per year. So to slow us down for the coming years, they started to slowly increase our interest rates, which at the time were basically near zero. At the same time, on the opposite side of the world, Japan's economy had the opposite problem. They had negative inflation, and their prices were falling, which is bad because whenever consumers see that prices fall, they don't want to spend their money and they'd rather wait until tomorrow, which means the economy doesn't grow, so prices fall even more, and this continues and perpetuates this never-ending problem. So while the rest of the world was raising interest rates, Japan had the bright idea to lower them instead, but lowering them not just to zero like the US did during the pandemic, but dropping the rates to below zero into negative interest rates. It was the start of something called YCC, the Yield Curve Control Experiment. Now, in the context of economics, the yield curve has accurately predicted 10 of the last recessions since 1955. So the theory is, if someone had the power to control their country's yield curve, they might be able to prevent recessions and artificially grow their own economy. And that was the start of the ultra-loose monetary policy that is sometimes referred to as Abenomics. Well, this year, though, marks the end of that experiment, and some economists are worried this will put a pressure on the US and by extension, the global economy as well. So that's what I want to try explaining in today's video, so let's get into it. Hi, my name is Andre Jik. Hope you're doing well. Come for the finance and stay for Japan, which brought me some of my favorite childhood experiences of all time, like Super Mario, Pokemon, Legend of Zelda, Street Fighter, Final Fantasy, and now the US recession's greatest hits, the Millennial Edition. Just kidding. Hopefully. So here's what's going on. I'll try to talk kind of slow in this video because it gets insanely complicated, but these videos are really hard for me to make because I don't fully understand the complexity of it all, but I'll try my best to explain. Let's start with negative interest rates though, because how can rates be negative? Because here in the US, interest rates for a 30-year mortgage reached 8% as a national average. And even back when rates were close to zero, the lowest I've heard anyone have is like a 2.5% mortgage rate. But if rates are negative, does that mean that people get paid to borrow money? No, but that'd be cool though. So what this is referring to is just the cost for banks to park their money with the central bank, the BOJ or the Bank of Japan. Now, this is just a way for Papa Bank to incentivize all the baby banks, the commercial banks, to lend out their money to their citizens instead of hoarding it for themselves. This way, by creating an environment of cheap money, it encourages people to actually go out and borrow money so they can build a business or buy a house. This was their attempt to control this yield curve. Now, the yield curve, by the way, if you're not familiar with it, is just a graph that shows the difference between lending money in the short term versus the long term. And in a healthy economy, it should look something like this. Lending money for the long term is more risky, therefore interest rates on long-term lending will be higher. That's a normal yield curve. Think of it like this. If your friends asked you to borrow money in the short term versus the long term, you treat it a little differently. Like if my friends came up to me and asked me to borrow money for 10 days, I'd give them the money and I wouldn't even worry about the interest. But if they asked me for 10 years, I'd be like, you better pay up. But if that situation is reversed and you start to charge your friends more for just 10 days, that means you probably don't think your friend will be your friend in 10 years from now, or you don't trust them as much, so of course you're going to charge them more in the short term. And that's bad news. And when the yield curve in the bond market flips like that, it usually means a recession is going to happen at some point. And spoiler alert, the US has been in this inverted yield curve for a while now. But Japan figured if they could somehow control that friendship and maybe buy a couple friends by way of suppressing their short-term interest rates for their bonds, that their long-term bond rates would just have to be higher. Kind of like if you go through life having low or maybe negative expectations, in the long term, you'll be pleasantly surprised. And that's also how I won the Most Improved Award. I digress. It's probably a bad analogy, but you get the idea. And now Japan's experiment of keeping their short-term interest rates low is coming to an end in the first half of 2024, and that's what people are afraid of. Okay, so now the question is, why are some economists afraid if Japan raises interest rates? It's not like it affects our ability to borrow money, doesn't affect the US that much. Not a lot of people know that the way the United States borrows money is by issuing or creating treasury bonds. And when it creates those treasury bonds, it needs investors to buy those bonds. Well, how does it do that? By making bonds have higher and higher interest rates so that we can make more money. And the way to do that is for the Federal Reserve to increase interest rates. And as we know, when raising rates, you affect unemployment because more people could lose their jobs. It makes it more expensive to borrow money and open credit cards. And it makes US debt much more expensive because the interest payments start to go up. So much so that the US has to borrow even more money just to make the payments on its interest. And a lesser known fact about all this is that the biggest buyer of US debt also happens to be Japan. And that makes perfect sense. If you're an investor living in Japan, or you're a life insurance company or a bank and you have this money, you don't want to put it into the JGB, the Japanese government bond, because that's paying you less than 1% on your money. In some cases, they are charging you to put their money there. So instead, you're going to look for something that pays you a juicy yield, something that's stable, and something that's been known to never default on its debt. And at the top of your list would be US Treasury bonds. That's also why Japan has been the biggest buyer of US debt. They own 147 trillion yen, or about $1 trillion worth, which puts them at the global top among all the other countries in the world. So economists are worried that if Japan raises interest rates enough to be competitive, it would discourage our biggest buyer, Japan, from buying our treasury bonds, and it might even incentivize them to sell off those treasury bonds instead. And that's why right now there's some price instability or volatility in the bond market. Because the world right now, especially the banks, which are some of the biggest holders of US debt, aka those treasury bonds, are saying to themselves, wait, so if Japan starts to sell off those treasury bonds, does that affect my US treasury bond portfolio? And of course it does. Because if an entire country starts to sell off those assets, it would negatively affect those bonds as well. So that's impact number one. Here's impact number two. If the United States keeps borrowing and keeps spending money like it's doing at a record drunken sailor pace, it means it would have to increase interest rates even more. Because in order to attract those foreign buyers to buy our bonds again, we have to raise our interest rates. And as we've learned, the negative side effect of doing that is that it increases the payments on our debt, which means we have to borrow more by creating more treasury bonds. But who's going to buy them? Oh no, we have to raise our interest rates again. It's a continuing, self-perpetuating problem that's bad for employment, consumers, the entire middle class, and the country as a whole. Now I know that all of that sounds scary, but the truth is I have no idea what the real effects will be. No one knows because we can't predict how much Japan will sell our treasury bonds, and how much will they increase their interest rates by. Will it be enough to stay competitive or dissuade Japan from buying our thick boy juicy bond yields? No one knows. So to calm us down, I'm going to give you some of the counter arguments for why some people think this might turn out to be a nothing burger in the end. And one of the reasons why this could end up going nowhere is because of debt. For example, Japan has a 263% debt to GDP ratio, which is the highest of any developed country in the world. It owes roughly 2.6 times what the country makes in a single year. And that should give Japan a lot of reason not to raise rates too high, because having those rates too high means their interest payments on their debt will become that much more expensive, which would also make it easier for them to default on their payments to their bondholders, which they don't want to do. But reason number two this could end up going nowhere is because Japan does not want to see the failure of its own banks. And we saw that happen in the US earlier this year, and just as recently as this past week, we had another smaller bank fail in Iowa. Because the US raised interest rates too high too fast, it made a lot of banks go insolvent. And they became insolvent because they parked a lot of customer deposit money into treasury bonds back when they were paying a very low interest rate. So when the Fed started to increase interest rates, the value of those bonds started to go down. So when people wanted their money back, they couldn't give them all of their withdrawals, and so they failed. And that's what the Bank of Japan should be very careful of repeating that same mistake. Now, the third reason why this might end up going nowhere is because of public debt. Specifically, mortgage loans with variable interest rates. For example, when I bought my rental property, I bought it with a 7-to-1 variable rate. That means my rate is locked for 7 years, but after 7, it will have one adjustment. Whatever the rate will be in 7, that's what I'll have to pay. And a lot of people did that to lower their monthly payment. The problem with doing that, though, is if you miscalculate in the future and you can't afford your monthly payment, which could have doubled as a result, then you could end up losing your house, and that's not something a country wants to have happen to its citizens. And reason number 4 why they'll have to be extra careful is because of the stock market. So check this out. When Japan raises interest rates, that will make the yen stronger against the dollar, which sounds like a good thing for Japan. But when Japan's private sector sells all the products overseas and it converts the dollars that it's made back into yen, they'll have less yen for it. That means those private companies will make less money. They're less profitable, which hurts the stock market. But who does that ultimately hurt? You'd think private investors. But believe it or not, the number one investor in the Japanese stock market is the Bank of Japan. That is bananas. That's like the Federal Reserve being the number one shareholder of the US stock market. That's another huge reason why the Bank of Japan wouldn't want to raise interest rates too fast, because it doesn't want to hurt itself. And frankly, reason number 5 why Japan may not even sell US Treasury bonds all that much is because they are worth less today than what they paid for them. So they don't want to sell them at a loss. Now, there's a lot of other complicated reasons that I won't go into, but the point is, sure, this could have some negative side effects on the US economy, but overall, probably not as bad as some people expect for it to be. All in all, if I could share my own opinion about all this, if I were a betting man, I would say this entire situation with Japan probably won't have that much of an effect on the US economy, and will still keep going on the same path. We'll still continue kicking the can down the road if we have to. We could lower rates to 0 and indefinitely keep going. And I don't think this will be the match that lit the fuse, so to speak. It's still not the best thing to have happened, but I still think it's important to understand what's going on with the economy and how it could affect the world. But I hope all this helped you understand just a little bit. And as always, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. Links are down below, and to go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday. See you soon. Bye-bye.